Imagine two people opening their mail on the same morning. One lives in Milan, Italy, the other in Amsterdam, in the Netherlands. They both read a letter from their bank. Their monthly mortgage payment has just increased by €300. Neither lost their job, neither took on reckless new debt. Yet, with a single signature, hundreds of miles away, someone has just taken a slice of their savings. Welcome to the reality of the European Central Bank. You hear about the ECB all the time in the news, but let's clear up a big misunderstanding. The ECB does not govern all of Europe. The European Union has 27 countries, but the ECB controls only the 21 that use the euro. Since 2026, with Bulgaria joining, that is the true border of its authority. If you live in one of those countries, the ECB is the most powerful unelected force affecting your financial life. Every 6 weeks, just 27 unelected people, the 6 members of the executive board and the 21 national central bank governors, sit in a room in Frankfurt to dictate the cost of living for over 350 million citizens. It has a monopoly on creating your money and, more importantly, it sets the price of that money through interest rates. Here's what the financial media rarely explains. The ECB is not a secretive group of bankers plotting in the dark. It is a machine, a system built on a mathematical flaw dating back 30 years. And we're not the ones saying this. Mario Draghi himself admitted it. That flaw structurally benefits some nations while putting others at a disadvantage. In this video, we will open up that machine. We'll show you why the system is broken by design. And by the end of these 20 minutes, you will know how to read the news, anticipate the ECB's next move, and understand the secret geopolitical war currently being fought to finally fix this broken machine. Welcome to Amazing Europe. To understand why the ECB feels so unfair, you must first understand its main tool, the single interest rate. Think of the interest rate as a central heating thermostat for a massive apartment building. Imagine some tenants live in the freezing winters of Northern Europe. Others live in the sunny Mediterranean south. But the building only has one thermostat. This is the impossible job of the European Central Bank. When inflation gets too high in a strong economy like Germany, the ECB has to turn down the heat. They raise interest rates. This makes borrowing money much more expensive. If loans are expensive, people stop buying houses, businesses stop expanding, and spending drops. When nobody is buying, prices stop going up. That is how they cool down inflation. But what happens to countries in the south, like Italy, Spain, or Greece? If their economies are already struggling, they get frozen because money suddenly becomes too expensive to borrow. Their already weak economies are pushed directly into a recession. It is a single suit that doesn't fit anyone perfectly. But the problem goes much deeper than just geography. The real trap is how money actually flows to businesses. And this is exactly where Southern Europe gets crushed. In Northern Europe, large corporations do not rely only on banks. When they need money to grow, they go to the financial markets. They issue corporate bonds. They get cash directly from global investors at locked-in prices. This means their funding is secured for years, no matter what the central bank does today. But the economy of Southern Europe, in countries like Italy, Spain, or Greece, is completely different. It is built almost entirely on micro, small, and medium enterprises. These local businesses are usually too small to use the stock market or issue corporate bonds. They are completely dependent on local commercial banks for their survival, and historically, a massive portion of these commercial loans in the south were tied to variable interest rates, making these businesses hypersensitive to every single move made in Frankfurt. This structural difference creates a devastating chain reaction. When the ECB announces a rate hike, a large German or Dutch multinational barely feels the impact immediately. Their funding is already locked in on the financial markets. But for a small manufacturer in Naples or Athens, the cost of their bank loan skyrockets overnight. their credit line becomes too expensive to maintain. Hiring stops, growth dies. When the ECB pulls the lever, the pain is never distributed equally. It hits the bank-dependent South with the force of a hammer. Economists have known about this flaw for decades. It is a basic rule of macroeconomics. You cannot successfully share a single currency unless you also share a single government to balance the wealth. Look at the United States. If the state of Louisiana is struggling with an economic crisis, the federal government in Washington steps in. It takes tax money from wealthy states like New York and sends it to Louisiana to absorb the shock. In Europe, that does not happen. There is no massive federal budget to save struggling nations. There is only the ECB pulling one single lever for 21 vastly different economies. And mathematically, the weakest links always break first. But why did Europe build a central bank this way? Why create a system that ignores local economic pain by design? To answer that, we have to look at the law. A law written over 30 years ago, designed to calm the historical terrors of just one powerful nation. So, if raising interest rates crushes the economy of half the continent, why does the ECB keep doing it? Are they just out of touch with reality? No, they are following the law, and to understand how ruthless this law is, you just have to look across the Atlantic Ocean. Look at the Federal Reserve in the United States. By American law, the Federal Reserve has what is called a dual mandate. They are legally required to do two things at the exact same time: keep prices stable and maximize employment. If the US economy crashes, the American Central Bank is legally forced to care about people losing their jobs. They have to balance inflation with human suffering. Now, look at the European Central Bank. According to Article 127 of the European Treaty, the ECB has only one primary goal: price stability. It was the ECB itself that later translated this law into a strict mathematical target, keeping inflation at 2%. That is their absolute priority. Yes, there is a tiny secondary clause that says they should support the general economic policies. But that is just a legal fig leaf. It explicitly states they can only support the economy if inflation is already under control. What does this actually mean for you? It means that if inflation spikes, even if it is caused by something Europe cannot control, like an unpredictable war or a global energy crisis, the ECB is legally forced to raise interest rates and crash demand. They have to break the economy to lower the prices. Your local business closing down, your mortgage doubling, your job disappearing. To the ECB, these are acceptable casualties. They are legally blind to unemployment if the inflation alarm is ringing. It is a law of sacrifice. But who would write a law that ignores human jobs? Why would 21 different countries agree to build a central bank that only cares about prices? To find the answer, we have to go back to 1992. The Maastricht Treaty. This was the moment when the euro was decided. France desperately wanted a single European currency to tie the continent together. But Germany already had the strongest, most stable currency in Europe, the mighty Deutsche Mark, and the Germans did not want to give it up. To understand their hesitation, you have to understand the deepest trauma in modern German history. In the 1920s, during the Weimar Republic, hyperinflation absolutely destroyed Germany. Money became so worthless that people were bringing actual wheelbarrows full of cash just to buy a single loaf of bread. For the German psyche, inflation is the ultimate evil. It is a social cancer, far more dangerous than unemployment. It destroys democracies. So, when France asked Germany to share a currency, Germany made a strict, non-negotiable demand. They said, "We will accept the euro, but only if the new European Central Bank is an exact copy of our own Bundesbank." It had to be located in Frankfurt. It had to be completely independent from politicians. And it had to have a blind, absolute obsession with fighting inflation above everything else. This is exactly what former ECB President Mario Draghi meant when he recently warned that Europe's rules were designed for a world that no longer exists. in his landmark 2024 Competitiveness Report, and again in his 2025 and 2026 speeches, Draghi explicitly stated that the EU is paralysed by outdated rules and a slow institutional model. The rigid laws choking Southern Europe today are not an accident. They were the political price paid to convince Northern Europe to join the euro in the first place. A single currency, managed by a bank designed to fight the ghosts of 1920s Germany, but forced to deal with the complex crises of 2026. And in the last decade, this exact mechanism triggered one of the largest transfers of wealth in human history. Now we reach the chapter most people never connect to their own lives. After the euro crisis, the ECB faced a nightmare. Interest rates were already close to zero, but the economy was still barely growing. To save the system, they introduced a massive new tool, quantitative easing. In simple terms, they created trillions of euros out of thin air. But here is the catch. The ECB creates new money, but it doesn't deposit it evenly into everyone's bank account, like cash falling from a helicopter. Instead, it uses that money to buy bonds from banks and large financial institutions. To see how it works, picture a pyramid of champagne glasses. The ECB pours a huge bottle into the single glass at the top. That glass represents big banks, hedge funds, and financial institutions. They receive the new money first. And what do? They don't raise wages. They invest. They buy stocks, corporate bonds, entire blocks of real estate. They channel that liquidity into financial markets, pushing asset prices higher. Only when the top glasses overflow does the money drip down to the middle and bottom ones, the real economy and ordinary workers. But by then, something has changed. All that buying at the top has already driven prices up. Houses cost more, rent is higher, groceries are more expensive. When the bottom finally receives a few drops, the cost of living has already risen. Here's what that means in real life. If you owned an apartment in Milan or Madrid in 2015, its value had doubled by 2022. You didn't need special skills. You were simply closer to the top when the ECB opened the tap. But if you were 30 in 2015, saving in a checking account for your first home, you were at the bottom. Each year, more money flowed into the top, and property prices moved further out of reach. Your salary barely changed, while the home you wanted kept getting more expensive. Your savings lost purchasing power, sitting in an account earning almost nothing, and your rent increased too, because property values rose. This is what is known as the Cantillon effect, and what we've just seen is its everyday application. New money doesn't arrive everywhere at once. It reaches those closest to the financial system first, and the rest absorb the cost. This created what one might call the reverse Robin Hood effect. It was one of the largest legal transfers of wealth from the middle class to the asset-owning elite in modern history. Not because of a conspiracy, because of pure mechanics. But if this is how the machine works, the real question is simple. Why hasn't anyone fixed it? Before we look at the battle to finally fix this system, if you are finding value in this breakdown, please hit the like button and subscribe with the bell. It helps us expose these stories to more people like you. At this point, you might be thinking, if the system is so clearly flawed, why hasn't anyone fixed it? The answer is not ignorance. The people at the top know exactly what is wrong. The answer is a genuine, deep and legitimate disagreement between nations with completely different historical experiences. To understand it, we need to look at what is happening right now in 2026 behind closed doors in Brussels and Frankfurt. In 2024, the European Commission asked Mario Draghi, the man who literally saved the euro in 2012 with 3 words,
"Whatever it takes,"
to write a report on the future of European competitiveness. What came back shocked the entire European establishment. Draghi's report was not a reassuring document. It was a fire alarm. He wrote that Europe is falling dangerously behind the United States and China. that the EU's outdated institutional rules, including the rigid architecture of the ECB, were designed for a world that no longer exists. He explicitly called for a new model, one that includes a form of common European debt, similar to US Treasury bonds, to give the Eurozone the fiscal backbone it has always lacked. For the first time in decades, a figure of that institutional authority had said in public what many economists had been whispering for years: the machine needs to be rebuilt. The most discussed solution today is often called Eurobonds or common debt. Here is the simple version. Right now, when Italy needs to borrow money, it goes to the market alone. Investors look at Italy's debt levels and charge a high interest rate to compensate for the risk. The same happens to Spain, Greece, and Portugal. Meanwhile, Germany borrows at almost zero cost because investors trust the German government completely. The result? Southern countries pay more to borrow, which makes their debt grow faster, which makes investors charge them even more. It is a vicious cycle that the single interest rate of the ECB cannot fix alone. A common European debt instrument would change this completely. Instead of Italy borrowing alone, the entire Eurozone would borrow together with a shared guarantee. A bond backed by 21 economies is far safer than one backed by just one. This would dramatically reduce the borrowing costs for the weakest members and create the fiscal shock absorber that the euro has always been missing. During COVID, Europe actually did this for the first time in history with the Next Generation EU Fund. It was temporary, but the taboo had been broken. Generally speaking, Northern European countries do not like the idea of common European debt. Now, before you think this is an obvious solution that only selfishness is blocking, stop. Because the position of northern countries is not simply greed, it is a legitimate, deeply rooted concern that needs to be understood. Put yourself in the shoes of a Dutch or Finnish citizen for a moment. Your country has spent decades building a reputation for fiscal discipline. Your government balanced its budget. Your pension system is solid. Your public debt is low. Now someone asks you to put your national signature and your tax money as a guarantee for the debts of countries that historically ran large deficits. From that perspective, the fear is not irrational. It is the fear of moral hazard. They say, if a southern country knows that its debts are guaranteed by the whole of Europe, what is the incentive to keep its own finances in order? This is not a question about which nation is better or worse. It is a structural problem of trust between countries with very different fiscal traditions, and it is a problem that any serious solution must address honestly. The debate is open and alive, and the pressure is growing. The geopolitical shocks of recent years, the pandemic, the energy crisis, the war in Ukraine, the new American trade policy, have made one thing clear to almost every European government. The old model of a fragmented Europe, where each country fights alone, is no longer viable. Even some northern governments are beginning to accept that deeper fiscal integration is not a gift to the south. It is a necessity for the north too, because a stagnating, fragmented southern Europe is also a shrinking market for German exports and Dutch technology. Europe's strength has always been its unity. Its weakness has always been the speed at which it builds that unity. What we are watching today is not the collapse of the European project. It is the slow, painful, and deeply human process of 21 Eurozone nations learning to trust each other with their money. And you? What do you think about the European Central Bank? Will Europe manage to unite and truly seek the well-being of all its citizens? Or will things continue this way? Let us know in the comments. If you found this topic interesting, we highly recommend this video where we look at 5 European countries that were literally on the brink of bankruptcy in recent years, and we will see exactly what role the euro played in all of it. That is all for this video. See you next time.